have been actively developing in recent years. Which market has stronger momentum and which one might slow down? Let's talk to Archie Hart, co-portfolio manager of emerging market equities at 91. He joins us from London, UK. Thanks for being with us, Archie.
Hi, Mark. Thanks for having me. I appreciate the time.
All right, so let's start with U.S. tariffs. Donald Trump brought them in the first time around with China. Biden kept them going, President Biden. So what do you think tariffs will look like for China under the second Trump administration, Trump 2.0? And what will the magnitude be, do you think?
I think we're at a really interesting juncture in markets. I mean, as you know, I think there's an ironclad consensus that the new Trump administration is great for America and pretty bad news for the rest of the world. And that's particularly emerging markets, and a lot of that's around tariffs. But I think the key thing for us here is that we're 8 years into this regime. So most of what we're seeing, direction of Trump's policy, came in 2017. Biden's continued on, and we're now going into, if you like, year 9 of that. And there's been quite a big adjustment globally. So if you look at China's exports to the US, they're down 20% from the peak already. China's done a very good job of diversifying outside the US. So yes, tariffs are existential for Canada and Mexico, but actually only 13% of China's trade goes to the US. 87% goes elsewhere. So they're already significantly diversified. So for a lot of places in emerging markets, those extra tariffs are headwinds, but also there will be some gainers as some of that trade gets reallocated out of China to the rest of the complex, whether that's Eastern Europe, perhaps India, perhaps Southeast Asian nations, perhaps Vietnam, etc.
Just sticking with China here, there seems to be a consensus that economic growth is quite weak right now. Chinese bond yields are at levels, low levels we haven't seen in perhaps forever. Factory pricing has fallen 27 straight months. So are the stimulus measures working at all? And where are the opportunities in China, if any?
So I think with China, the issues in China are domestically made. They're not American-made, they're domestically made. So the important decisions on China won't be made in Washington, D.C., they'll be made in Beijing. And I think we're looking at a long bond yield of 1.6% in China now. That's telling you that the markets are deeply concerned about deflation, deeply concerned about a lack of growth, and they simply think the Chinese government is behind the curve. And so what we've seen is this very gradual rollout of various measures to try and prop up the property market, cut interest rates, stimulate more bank lending. But the market says it's too slow, not enough, needs to happen at a faster, more vigorous pace. So we'll see whether that happens. Within the overall market, though, we think there's lots of bottom-up opportunities because there's a lot of change happening. So Chinese are trading down. So they're going out to restaurants less. So they're ordering more taking food. So China's Deliveroo, a company like Meituan, is benefiting from that. Consumers are trading down from high-end luxury goods to more mid-market, better value products. And again, there's lots of opportunities there. An aging population means more need for healthcare and pensions and life insurance. Opportunities there. And lastly, China's companies, they see this, they understand what's happening in the economy, and they're reacting. They're cutting costs, they're restructuring, they're giving cash back to shareholders, higher dividends, higher buybacks. So we're not excited about the market, we're not excited about the economy, but gosh, we see some real excellent bottom opportunities within the market.
Okay, and you gave us some ideas there as well, Meituan being one of them. Now, as far as the U.S. dollar, usually when it's strong, the thinking is that that is bad for emerging markets. But do you think a stronger U.S. dollar is maybe more benign than most people think?
So, yeah, I mean, typically you'd expect a strong dollar to be bad for the asset class. The asset class last year was up 8%, so not huge returns, but decent returns in US dollars. But that was after a 7% headwind from the US dollar. So strong US dollar last year, we still had positive returns. I almost think if you're worried about the dollar, I wonder where you've been the last 15 years. So on a trade-weighted basis, the dollar's up 40% in the last 15 years. So we've been living with a strong dollar now for quite a time. We'll see how that continues. But broadly, I think a strong dollar is consensus and therefore to a great extent priced in. The reason you're able to buy emerging market equities at 12 times earnings is because of the headwinds people see, whether that's Trump or tariffs or what's happening in China or the dollar. So to a great extent, I think the market's fully aware the dollar's strong and has priced some of that. And that's where the upside comes from, is that if that consensus weakens around any of these issues, there's a huge amount of upside in the asset class.
Now, as far as India, that economy had been growing great guns. I believe they posted a quarter where GDP was 8%. The stocks have rolled over maybe a little bit lately. But what do you think about China? I understand you think long term it could be bigger than China.
Yeah, you mean India?
Sorry, India. Yeah, India could be bigger than China.
So to explain what's happening in India, so why is this growth accelerating in India? One of the big things I think which people don't focus on is they've had this program of giving out ID cards. So previously in India, you were born in a village, you had no ID, you couldn't buy a phone, you couldn't get a bank account, you couldn't vote, the government couldn't send you support payments and support you welfare-wise. 500 million Indians have received ID cards in the last 10 years. 500 million people can now buy a phone, get a bank account, receive benefits from the government. You think about injecting 500 million people into any economy, that's an extraordinary thing to happen. And we think the benefits of that just go on a multi-year basis. And wherever you look in India, you can see opportunity. So India spends about $200 a year on healthcare per person. The US spends $12,000 per head per person on healthcare. If we look at property, the US is completing about 600,000 housing units a year. China at the peak did 19 million units. Now clearly 19 million is a crazy number. But I think what we're going to see is plenty of scope for industries to grow. And yes, we think potentially India is the biggest emerging market on a 5-year view.
All right, very